Money only works because people believe it will work tomorrow. The moment that belief cracks, everything else collapses behind it. Now imagine living in a country where money doesn't fail all at once. It fails quietly, unevenly, and constantly. Where the bill in your pocket might be accepted at full value in one town, discounted in the next, and rejected entirely a few miles down the road. Where every purchase feels less like shopping and more like gambling. This wasn't a dystopian experiment. This wasn't a financial collapse. This was the United States of America. Before the Civil War, America didn't have a currency system. It had a currency problem. There was no single dollar, no standard paper money, no institution guaranteeing that a piece of paper labeled $5 was actually worth $5. Instead, the country was flooded with privately issued banknotes, thousands of them, each backed by a promise that might or might not be real. Money didn't represent value, it represented trust, and trust was fragmented. A merchant in Ohio didn't just sell goods, he evaluated risk. When a customer handed over a banknote, the merchant had to ask silent questions. Who issued this? Is the bank still operating? How far away is it? Would anyone actually redeem this for gold if needed? Entire books existed just to answer those questions. They were called banknote reporters, massive printed catalogs listing thousands of banks, their reputations, and the current discount rate applied to their notes. A $10 bill from one bank might only be worth $8 today. Tomorrow, it might be worth nothing at all. Commerce slowed, prices fluctuated, transactions stalled. And yet the system persisted, not because it was good, but because it was profitable. State-chartered banks were allowed to issue paper notes as long as they promised to redeem them for gold or silver. But many of these banks were never designed to honor that promise. Some were deliberately placed in remote locations, swamps, forests, frontier towns, places difficult to reach and easy to abandon. These institutions became known as Wildcat banks, not because they were illegal, but because they operated where wildcats roamed, far from anyone who could hold them accountable. The business model was simple. Issue as many notes as possible, let them circulate in cities where people wouldn't try to redeem them, and disappear before anyone realized the gold wasn't there. By the time the fraud was discovered, the damage was already done. Historians estimate that at any given moment, 1 out of every 3 paper dollars in circulation was counterfeit. Not inflated, not devalued, fake. This wasn't just a nuisance, it was a tax on the entire economy. Every transaction required verification. Every payment carried doubt. Merchants demanded discounts to protect themselves. Deals collapsed because no one could be sure what money was actually worth. Growth slowed. Efficiency vanished. Trust eroded. But the system limped along until something exposed how fragile it really was. War. In 1861, the United States split apart, and suddenly the federal government faced a challenge far greater than bad money. It had to fund the most expensive war in its history. Wars do not tolerate uncertainty. Soldiers must be paid, weapons must be built, food must be moved, horses must be fed, ships must be launched. None of that can run on questionable paper promises issued by scattered private banks. In earlier conflicts, the government borrowed gold from banks, but this time the banks themselves were unstable. When the Treasury went looking for real money, the system cracked under pressure.
Banks panicked. Gold disappeared. Paper promises were exposed. The financial system didn't just strain, it froze. At the exact moment the nation needed trust the most, trust evaporated. The Union wasn't only fighting the Confederacy, it was fighting its own monetary system. At the center of this crisis stood a man who, by belief, should never have been the one to solve it. Salmon P. Chase distrusted centralized banking. He believed in hard money, gold and silver. He feared federal control over finance and viewed private banking power with suspicion. In another era, he would have opposed the idea of a national currency outright. But history does not reward ideological purity. It rewards survival. Chase understood something brutal and unavoidable. You cannot fight a modern war with a medieval money system. You cannot rely on 1,500 competing banks, many of them fraudulent, to finance the survival of a nation. You cannot build a unified army on a fragmented currency. The problem was no longer efficiency, it was sovereignty. So Chase did something deeply uncomfortable. He designed a system that would centralize control over money without openly banning anyone from participating. Instead of creating a single central bank, he proposed something more subtle, a new category of banks, nationally chartered, federally supervised, bound directly to the government. These banks would issue a new kind of paper money, uniform in appearance, identical in value, and accepted everywhere in the Union. But there was a condition. To issue this money, banks had to buy United States government bonds and deposit them with the Treasury. Every dollar printed would be backed by federal debt held in Washington. This did two things at once. First, it cleaned up the currency. If a bank failed, the government could sell the bonds and redeem the notes. The paper was finally trustworthy. Second, it turned the banking system into a financing engine for the war. Every new bank meant more government debt purchased. Every dollar of currency meant money flowing to the Union Army. This wasn't persuasion, it was financial engineering. In 1863, Congress passed the National Banking Act. It was revised and strengthened in 1864. On paper, the solution was elegant. Order replaced chaos, trust replaced rumor, uniformity replaced fragmentation, but reality interfered. State banks did not rush to join. They disliked federal oversight. They resented the restrictions. They preferred the old system, dangerous, inefficient, but immensely profitable. Under the national system, freedom shrank. Under the old system, control remained local, so most banks stayed put. The result was confusion. National banknotes circulated alongside state banknotes. Government-issued greenbacks circulated alongside both. 3 types of money, 3 levels of trust, 1 economy. The chaos lingered. Chase had offered an incentive. The banks refused. And this is the moment where American money changed forever. Because when persuasion failed, the federal government reached for something far more powerful than regulation. It reached for mathematics. When incentives fail, power gets creative. By 1864, the federal government had tried cooperation. It had offered state banks a choice: join the national system, accept federal oversight, and issue uniform money backed by government bonds. The deal was rational, it was clean, it was even profitable, and most banks ignored it. From their perspective, refusing made sense. Under the old system, issuing paper money was enormously lucrative. Oversight threatened margins, federal audits threatened autonomy, and surrendering currency control meant surrendering influence.
For decades, state banks had been the source of money itself. They decided how much circulated, where it flowed, and who benefited. That power was not something they were eager to give up voluntarily. So the chaos continued. Americans were now juggling 3 forms of money at once: state banknotes of varying quality, national banknotes with federal backing, and greenbacks issued directly by the government. Each carried different levels of trust. Each traded at different values. Each required mental calculation. The war was reaching its climax, but the monetary system remained fractured. Salmon P. Chase understood what this meant. If the federal government wanted a single national currency, persuasion was over. The question was no longer how to encourage compliance. It was how to end resistance. This is where American monetary policy crossed a permanent line. Instead of banning state banknotes, a move that would have triggered open rebellion, Congress chose something quieter, something more sophisticated, something far more effective. They chose a tax. In March of 1865, as Confederate armies collapsed and the war neared its end, Congress passed the Revenue Act. Its stated purpose was to raise money, but buried inside the legislation was a provision that had nothing to do with revenue and everything to do with elimination. A 10% tax on the face value of all banknotes issued by state-chartered banks. Not a tax on profits, not a tax on transactions, not a tax on income, a tax on existence. To understand why this was lethal, you have to think like a banker in the 19th century. If a bank issued a $100 note, it might earn $6 or $7 per year lending that money out. The moment that note entered circulation, the federal government demanded $10 in tax. Every note guaranteed a loss. No amount of efficiency could fix that. No scale could offset it. No business model could survive it. Issuing state banknotes instantly became irrational. The message from Washington was unmistakable. If you want to issue money, you will do it on federal terms. If you refuse, you will be taxed out of existence. The reaction was immediate and furious. State bankers called it tyranny. Governors called it an attack on state sovereignty. Legal scholars argued that the Constitution granted Congress the power to coin money, metal, but said nothing about destroying paper instruments issued by private institutions chartered by states. To them, this wasn't taxation, it was economic warfare. And they weren't wrong. But America had been at war for 4 years. Cities had burned. Hundreds of thousands had died. The federal government was not in a mood to compromise over monetary authority it believed was essential to national survival. So the fight moved from Congress to the courts. A small bank in Maine refused to pay the tax. Its argument was straightforward. The federal government had no constitutional authority to tax a state-granted franchise out of existence. This wasn't revenue collection, it was annihilation. The case made its way to the Supreme Court, and history delivered a moment of breathtaking irony. The Chief Justice of the United States was Salmon P. Chase.
The same man who had designed the National Banking Acts, the same man who had supported the tax, now sat in judgment over whether his own strategy was constitutional. Chase did not recuse himself. He ruled. In his opinion, Chase reframed the entire debate. The issue, he argued, was not state rights versus federal power. It was whether Congress had the authority to create a sound and uniform national currency. And if competing systems interfered with that goal, Congress had the power to restrain them. Then came the sentence that would echo through every future fight over money and power. The power to tax, Chase wrote, involves the power to destroy. With that ruling, the constitutional debate ended. State banknotes vanished almost overnight. The discount tables disappeared. The counterfeit ecosystem collapsed. The books that merchants once relied on to decode money became obsolete. For the first time in American history, a paper dollar meant the same thing everywhere. Uniformity had won. But destruction never comes without consequences. The tax killed state-issued currency, but it did not kill state banks. Instead, it forced them to evolve. If they couldn't issue money on paper, they would issue it on ledgers. Deposits replaced notes. Checking accounts replaced cash. Instead of handing over physical promises, banks moved numbers between accounts. No paper, no tax. What began as a workaround became a transformation. Checks were safer, more flexible, easier to scale, and critically, untaxed. State banks found new life. Freed from the strict requirements of the national system, they focused on deposits, local lending, and community banking. Farmers, merchants, and small businesses found credit where national banks were too rigid to lend. By the late 19th century, the United States had something no one had fully planned: a dual banking system. National banks issued currency and served large industry. State banks moved deposits and served local economies. The law that was supposed to create a monopoly had accidentally created modern banking. Yet beneath the surface, a new problem was quietly forming. The national currency was safe, but it was rigid. And rigidity in a growing economy is dangerous. The design flaw was subtle but fatal. Under the national system, banks could only issue paper money if they purchased government bonds. More bonds meant more money. Fewer bonds meant less. That worked during the Civil War, when debt flooded the system, but wars end. In the decades that followed, the federal government ran surpluses. It paid down debt. The supply of government bonds shrank. At the exact same time, the American economy exploded. Railroads expanded, factories multiplied, cities swelled, immigration surged, productivity soared. The economy needed more money. The system provided less. Not because of incompetence, because of design. The currency could not expand when demand surged. It could not contract smoothly when pressure eased. It was tied to government debt instead of economic reality. The result was a recurring nightmare. Every autumn, farmers needed cash to pay workers and ship crops. Country banks drained reserves. City banks pulled funds from New York. New York banks, suddenly short on cash, called in loans. Markets crashed. Confidence snapped. Panic spread. This cycle repeated again and again. The currency was honest, but it was dumb. There was no shock absorber, no lender of last resort, no institution with the authority to act when fear took over. The system eliminated fraud. It had not eliminated collapse. And that realization would eventually force the country to accept something it had feared since the founding: a central bank. But that is the next chapter, because before America built the Federal Reserve, it had to learn a darker lesson, one that still shapes monetary power today.
That governments do not need to ban competing money to destroy it. They only need to make it unprofitable. By the turn of the 20th century, the United States looked like a financial success story. The currency was uniform. Counterfeiting was rare. Paper money held its value from coast to coast. Compared to the chaos of the Wildcat era, the system seemed disciplined and mature. But appearances can be deceptive. Beneath the surface, the American banking system was becoming dangerously brittle. The national banking framework had solved one problem brilliantly: bad money. But it had quietly created another problem that would prove far more destructive. The problem wasn't fraud, it was liquidity. Under the national system, money did not move freely. It moved through a hierarchy. Small country banks kept reserves in larger city banks. City banks kept reserves in a handful of central reserve banks, mostly in New York City. This created a pyramid of money. When times were calm, this structure seemed efficient. Idle cash flowed upward to where it could earn the highest returns, often financing stock speculation and industrial expansion. Credit was abundant, markets boomed. But pyramids are stable only when nothing shakes them. Every year, like clockwork, the system faced stress.
In the autumn, farmers across the Midwest harvested their crops. They needed physical cash to pay workers, transport grain, and settle accounts. Country banks handed over currency. Their reserves fell. To compensate, they withdrew funds from city banks. City banks, in turn, pulled money from New York, and New York was the keystone. When reserves drained from New York, the entire financial system tightened. Banks called in loans, credit dried up, markets wobbled, panic simmered just below the surface. Most years, the system survived, but survival came at a cost. Confidence eroded. Businesses failed, not because they were unproductive, but because money vanished when it was needed most. Economic cycles became extreme, long booms followed by sudden violent busts. The currency was safe, the system was fragile. By 1907, the cracks were impossible to ignore. That year, a failed attempt to corner the stock of a single company triggered a chain reaction. Speculation collapsed, rumors spread. Depositors rushed to withdraw funds from trust companies, financial institutions that operated outside the strict rules of national banks, but were deeply intertwined with the system. Cash evaporated. Banks stopped lending. Payment systems seized. Panic spread through New York's financial district with terrifying speed. And here is the most important detail. The federal government could do nothing. There was no central authority with the power to inject liquidity, no institution designed to calm markets, no lender of last resort. The Treasury had money, but no mechanism to deploy it fast enough. The national banks had reserves, but no coordination. Everyone acted defensively. Everyone hoarded cash. The system began to eat itself. At that moment, the United States discovered a humiliating truth. Its financial survival depended on a private citizen. J.P. Morgan was not an elected official. He was not accountable to voters. He held no public office, but he controlled enormous financial resources and, more importantly, the trust of other powerful bankers. As panic intensified, Morgan took control.
He summoned the leaders of major banks and trust companies to his private library. He locked the doors. He demanded transparency. He forced competitors to reveal their balance sheets. Then he decided who would be saved and who would be allowed to fail. Morgan organized emergency lending pools. He personally committed his own capital. He pressured institutions to support weaker firms, not out of charity, but because collapse would destroy them all. For weeks, the American economy ran on private authority. One man functioned as a central bank, and it worked. The panic subsided. Markets stabilized. Businesses reopened. Disaster was narrowly avoided. But the lesson was impossible to ignore. A modern industrial nation had been reduced to improvisation. While European countries relied on central banks to manage crises, the United States relied on the willpower and stamina of an aging financier. There was no guarantee the next crisis would find such a savior. There was no guarantee the savior would act in the public interest. The national banking system had passed the test of honesty. It had failed the test of resilience. The realization spread quietly at first, then decisively. Politicians began to acknowledge what had once been politically untouchable. Bankers, scarred by panic, reconsidered their opposition. Economists articulated what markets had already demonstrated. A currency can be sound and still be dangerous. A system can be orderly and still collapse. What the United States lacked was elasticity.
the ability for money to expand when demand surged and contract when pressure eased. It lacked a shock absorber. Fear of centralized power had shaped American finance for a century. Now fear of collapse began to outweigh it. The debate shifted. The question was no longer whether centralized monetary authority was dangerous. The question was whether the country could survive without it. The answer came slowly, through commissions, studies, and political compromise. No one wanted a single monolithic bank. No one wanted unchecked power. The solution had to feel American, fragmented, regional, restrained. But it also had to work. In 1913, that compromise arrived. The Federal Reserve Act did not destroy the national banking system, it absorbed it. National banks were required to join the new Federal Reserve System. Reserves that had once been scattered across a fragile pyramid were consolidated into regional reserve banks. For the first time, the United States had an institution designed not just to issue money, but to stabilize it. The currency became elastic. When demand rose, liquidity could be injected. When panic threatened, pressure could be released. The system finally gained a mechanism to respond to fear before fear became catastrophe. National banknotes faded away, replaced by Federal Reserve notes, the ancestors of the dollars we recognize today. On the surface, this looked like progress. In reality, it was the culmination of a lesson learned the hard way. The National Banking Acts unified money. The Federal Reserve unified response. But the most important legacy of the Civil War banking laws wasn't technical, it was philosophical. They proved that the government did not need to ban alternative money to eliminate it. It only needed to make competing systems economically irrational. That principle, first applied to state banknotes, became a permanent feature of monetary power. And once learned, it was never forgotten. Which brings us to the present. Because once again, private forms of money are multiplying. Once again, innovation is racing ahead of regulation. Once again, supporters argue that competition in currency breeds freedom and progress. And once again, the state is watching. History suggests it will tolerate experimentation for a time. But when private money threatens stability or sovereignty, the response will not be loud, it will be quiet, calculated, mathematical. Just like it was in 1865. History doesn't repeat itself, but it does reuse its tools. By the early 20th century, the United States had learned a painful lesson. A currency can be honest and still be dangerous. A system can be orderly and still collapse.
The National Banking Acts had ended fraud, unified money, and funded a war, but they could not protect the economy from panic. So the country accepted what it had feared for generations: centralized monetary power. The Federal Reserve did not erase the past, it absorbed it. It kept the national banks. It allowed state banks to survive. But it added something that had never existed before: an authority capable of responding to fear. For the first time, money could expand when demand surged and contract when pressure eased. Liquidity was no longer trapped. Panic no longer had to run its full course before relief arrived. The system was not perfect, but it was survivable. And that is where most history lessons end. But the most important legacy of the National Banking Acts wasn't structural, it was strategic. They proved something far more powerful than any single institution. They proved that a government does not need to ban money to kill it.
It only needs to make it unusable. The 10% tax on state banknotes did not criminalize private currency. It did not seize printing presses. It did not raid banks. It simply rewired incentives until issuing private money no longer made sense. The banks complied not because they were persuaded, but because the math left them no alternative. That lesson became permanent, and it quietly shaped every monetary conflict that followed. Fast forward to the present. Once again, we live in a world crowded with private currencies, cryptocurrencies, stablecoins, tokens issued by companies, protocols, and platforms across the globe. Each promises speed, freedom, innovation. Each asks users to trust code instead of institutions. If that sounds familiar, it should. The crypto ecosystem looks uncannily like the Wildcat Banking era. Thousands of issuers, assets backed by promises that depend on confidence, redemption guarantees that work until they don't. Supporters argue that competition in money is healthy, that governments should not monopolize currency, that freedom requires alternatives. These are not new arguments. They're the same arguments made by state bankers in the 1860s. And once again, the federal government finds itself watching a parallel monetary system grow outside its direct control. Once again, it raises concerns about stability, fraud, consumer protection, and sovereignty. Once again, it searches not just for rules, but for leverage. This is where history becomes uncomfortable.
The government does not need to outlaw cryptocurrency. It does not need to shut down networks. It does not need to seize wallets. It already knows a better method: taxation. Imagine a law that imposes a penalty on every transaction made with a non-government digital currency. Not a tax on profits, not a tax on gains, a tax on use. Buy a coffee with crypto? Lose 10%. Transfer stablecoins? Lose 10%. Overnight, private digital money stops functioning as money. It becomes an asset, a collectible, something you hold, not something you spend. That is exactly what happened in 1865. The banks believed the Constitution protected them. They believed state sovereignty mattered. They believed the federal government would never dare to destroy an entire industry without banning it outright. They were wrong. The National Banking Acts didn't just centralize money, they centralized trust. Before the Civil War, Americans trusted proximity. Their banker lived nearby. Their money came from someone they could find. Currency was flawed and dangerous, but it was personal. When it failed, you knew who failed you. After 1863, trust moved upward, to paper stamped by the federal government, to systems rather than relationships, to authority rather than familiarity. That shift made national markets possible. It made industrialization possible. It made modern commerce possible. It also made money impersonal. Money stopped being a relationship. It became infrastructure. And once trust is centralized, it almost never decentralizes again. That doesn't mean innovation stops. It means innovation is temporary. Every successful form of private money is eventually absorbed, regulated, or priced out of relevance by the system it challenges. The Wildcat banks learned this. The national banks proved it. The Federal Reserve institutionalized it. And now the cycle is turning again. New forms of money will always emerge. Technology will always move faster than regulation. Experimentation will always test the edges of the system. But history suggests the ending rarely changes. When private money threatens stability or sovereignty, the state does not argue forever.
It calculates. And when the calculation is finished, the outcome becomes inevitable. The dollar did not survive because it was perfect. It survived because it was protected, because it was enforced, because eventually people trusted it more than anything else available. That trust was built in war, maintained through crisis, and preserved through incentives. So when you swipe a card, tap your phone, or hold a dollar, you're not just participating in commerce, you're participating in a system born from desperation, engineered through law, and defended through mathematics. A system that learned long ago how to eliminate competing currencies without ever saying the word ban. The wildcats are gone, but the instinct that created them never left. And as history keeps reminding us, every time money gets interesting again, power soon follows. The real battles are not loud. They are not dramatic. They are not fought in headlines. They are fought quietly through design, incentives, and math. The National Banking Acts were not just a solution to a 19th century problem. They were a blueprint. And whether we are watching innovation or the opening chapter of another currency war depends on whether we remember how the last one ended.